Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Tim Gokey, CEO of Broadridge. Tim, nice to see you.
Andy, really good to see you today.
All right, so first of all, Broadridge, let's talk about that, of course. This is a company whose business is in sort of the back office and processing, and it's been a pretty good business. Tell us more specifically what the company's about.
Yeah, we are a $23 billion market cap global fintech company. We provide a lot of the core infrastructure behind corporate governance, capital markets, wealth, and asset management. And we really focus on creating industry solutions for things that are critical, that have to be right, often with a regulatory angle, but that are less differentiating. So an example would be we provide a lot of the infrastructure behind corporate governance, all the boards of directors elections in North America. On the fixed income side, in the back office, as you say, about 2/3 of fixed income in North America is on our technology platform. More recently, we have entered into the front office as well, so we're sort of front to back in serving capital markets. But this intersection where we provide these critical infrastructure across sort of subsegments of the financial service industry gives us a pretty interesting vantage point, sort of at the intersection of some of these things, and in terms of really understanding, in some cases, what it takes to get some things done, when there's change.
And the company has an interesting history. It was part of ADP at one point, right, or came from that. Can you tell us that story?
Well, yeah, it was founded in early 60s by the founder of ADP, Henry Taub, who said this payroll thing can't last forever and went across the river to found a new company focused on processing in the securities industry. And over time, that became sort of a core part of the fabric of Wall Street. And then in the mid-'80s, Rich Daley, who is still our chair, founded in a spare bedroom a business to solve what was a real problem at that time around corporate governance. So every public company needs to send proxy materials to every investor, but in many cases they don't know who the investor is. The brokerage firm knows who it is. So in those days, every public company independently sent materials to every brokerage firm who had to pass it on, and it was all paper in those days, and it was a sea of paper flying across Wall Street. And so he created a business to say, send it to me, and I will forward it on behalf of everyone. And his backer passed away. He ended up selling that pretty early on to ADP, and which turned out to be a really fortunate thing, because with ADP's backing as a AAA-rated company, they were able to really turn that into an industry utility serving almost the entire industry. And that grew rapidly in the 90s, really powered ADP's growth. And then ADP said, now this is sort of fully mature. It's not going to be a growth business. The management of what was then a division of ADP, but now Broadridge, said, no, there's so many other things that we could do. And so we separated from ADP in 2007, became an independent company. Both companies have continued to do well. There's some healthy competition there, but really since becoming independent, we've grown from about 3,000 associates and about $2.5 billion market cap in 2007 to 15,000 associates and $23 billion market cap today, all in that theme of, what's the next thing we can do for our clients that is non-differentiating but really important that we could do for the industry.
Right, sort of adjacent to what was core, and you just
start with one thing and keep sort of, do a good job on that, have clients be happy, and have them be happy for us to take on the next thing.
Can you be more specific about what you do, say, with regard to proxies? Because, we do still get paper proxies, and then there's also the option to get things electronically. What exactly is the part of that process that you're involved with?
Yeah, and first of all, I just want to say that it is more than 80% digitally. So if you're getting it by paper, you still have the chance to press that button.
I'm sure they would like
and
that.
Get it digitally.
Right.
When you think about this, it seems sort of simple, but it's a bit of a complex process, because going all the way back to who are all the account holders and what do they own, where are they? What are their preferences in terms of how they want to deliver it? And so we keep that synchronized with all the brokerage firms. Then what are the events from public companies? What are the issues that are going to be voted on? When is the meeting? And synchronizing all that to send the communication to the investors around the meeting and all the activities, taking back the votes from that, working usually with an independent tabulator. Some cases we're the tabulator to tabulate those votes, providing a 24/7, 365 technology platform back to all the participants, the brokerage firm, the public company, anyone who is contesting the election in terms of what is the status, what is the vote today. So, for instance, in the most recent contest, Disney, that people were hearing about, and there were, people saying, what was happening at the time. That's because, we were providing information to all the parties about where the vote tally was, every day.
So Nelson Peltz fighting Disney, you guys were behind the scenes facilitating,
sending the communications, taking back the votes, tabulating them, giving the results to all the parties. And then on the back end of it, there's a whole billing question, because the brokerage firms that are responsible for this, and the brokerage firms, about 85% of shares are held in street name, meaning the brokerage firm is the one who knows who actually has the shares. They get compensated for their part in all of this. So we bill all the public companies on behalf of the brokerage firms, give each public company a consolidated bill across all the brokerage firms that they deal with, take that back, keep the part that is our bill to the brokerage firm, and remit the rest to the brokerage firm.
So has activity there, Tim, picked up with all this shareholder activism in terms of people like Nelson Peltz, but also in terms of ISS and Glass Lewis and shareholder proposals?
Yeah, I think that really leads into sort of a broader theme of the whole democratization of investing. And that's been a theme that's been going on for, literally for 50 years, with investing becoming more cost effective, more products available, more access for investors to be able to participate. If you look at the number of investors that hold shares in the U.S., has gone from 49% to 59% over the past 10 years. So, pretty nice increase.
You mean retail investors? Is that what you meant?
The share of American households.
Oh, share of American households. Sorry.
That have
got
some sort of equity.
Yeah.
And so more people are participating, more digitized communications, so more ways to interact, and higher expectation of investors that they can participate. So all those things are happening in the background. Meanwhile, activism, sort of as an asset class, has been a growing asset class. And so there is a significant group of investors whose real point is to scan across public companies and to look for ones where they think, I could do better, or with some changes, there could be an increase in performance. And so they're looking at public companies saying, where can we get involved and make a difference? And of course, the public companies aren't thrilled about that. And so you do periodically get these contests where either an activist will say, without a contest, let me come and help you, and they might have an agreement to do that. Or if they can't agree, they will say, no, well, then we're going to run an election and try to put some of our members on the board.
Right.
An interesting nuance in that's happening right now is something that sounds sort of esoteric, but universal proxy. So until just last year, when there was a contest, which happens, a fair number of times a year, each side would independently send a ballot with a different slate for the board, and you had to sort of pick one or the other. And beginning last year, but really this year for the first time in sort of full force with a big contest like Disney, when you get a ballot, it has all the directors on one ballot. Sounds pretty straightforward, but not as simple as it sounds to change everything to make that happen. But that really, in subtle ways, changes the balance of power between activists and investors and public companies, because the activist doesn't need to go for the whole board. They can say, well, I'm just going to put 2 members on. And for investors, they say, well, how much can 2 members hurt? So it gives the activists a bit of extra leverage, as we saw play out with Disney.
I remember sometimes in these contests, you'd just get, back in the day when it was mostly paper, you'd get all kinds of material sent to you. But I want to ask you about passive investors. My understanding is that they're such a huge force in the market, obviously, but that they don't vote on most matters. Does that impact your business, and what's your take on that?
Yeah, I think it's another interesting dimension of this democratization that I was talking about. So, when you look at wealth management and sort of how investing is evolving, what you're seeing is many people evolving to sort of a barbell strategy, where they will use a passive investment like an S&P 500 fund to get market exposure, and then they'll use either a concentrated portfolio, perhaps a managed account, or an alternative investment to try to beat the market with so-called alpha. And because of that, the passive funds are growing massively. These BlackRock, Vanguard, others with things like the S&P 500, many other indexes. And those funds, those shares do get voted all institutionally controlled shares do need to be voted. There's a rule that says that, and for many public companies, a significant proportion of their shareholdings are through these passive funds. This has been a growing concern among policymakers that now do these very large asset managers have too much control over the public companies. And in response to that, many of the asset managers are saying a new innovation that we're helping them with, voter choice, which is another way of pass-through voting, which is I'm not going to vote. I'm going to devolve that back to my underlying shareholder. And that's easier on the institutional side because a lot of the institutional investors who invest in a fund, they would already have a voting platform. They'd already be voting on many of these issues. They can just feed this into their system. Retail investors, clearly, you don't want to be voting 500 different companies for your S&P 500 fund. What people are offering is your choice of policies. You could be sort of management-oriented. You could be ESG-oriented. You could be Catholic policy-oriented, and have a choice of, for your holdings, how do you like them to be voted by the asset manager. That's in its infancy, but I think we'll see a lot more of that.
Another couple trends that you guys are focusing on, I think, is accelerated trading and modernizing wealth management. Can you talk about those two, please?
Yeah. I think I'll just go to modernizing wealth management first because it plays directly off of the democratization. When you, again, look at that barbell strategy and you look at all the different alternatives that investors are looking at, it's also, on the passive side, it's a bit more of a commoditization of asset management. Advisors are trying to really add value partly by helping people select alternative investments, but partly by really helping them with financial planning, being there at critical moments. And that is requiring lots of new technology for wealth management firms. They're also being challenged by new entrants, app-based investing and others that are fully digital. And so most wealth management firms are really thinking about their business model. How are they going to provide, create value, make money, and how do they align their technology platform with that? Right. And that's an opportunity for us to build what we think is the platform of the future that enables our clients to bring together many different technologies, even from different suppliers, maybe from us, maybe something they built, maybe a third party, and have it all work together seamlessly. And that, I think, will be a big theme over the next few years in wealth management.
You became CEO in 2019, I think. Is that right?
I did, yes.
And the
Just
stock...
had my 5th anniversary.
Congratulations. The stock seems to have matched the market at times, say the S&P 500, and at times exceeded it. Why is that? Performance.
Yeah, well, when I think about what we try to do, we try to have a very simple business model of growing first of all, we have a huge market to serve. And our market for what we do is really, our fee revenues are $4 billion. Our clients spend $60 billion doing things that we already do. So as long as we're good enough, we think there's basically infinite opportunity for us to grow. And we seek to grow our revenues 5 to 7% organically, 5 to 8% was our most recent guidance. Do a little bit of tuck-in M&A to grow our revenue 7 to 9%. With the operating leverage of being a technology company, we can grow earnings 10. Buy back a point of shares, pay a 2% dividend. We can deliver low teens returns to shareholders over long periods with low volatility, high defensiveness, and that is pretty attractive to investors. And when you look at long-term returns for the S&P 500, if you're in the low teens, you won't be in the top in any given year, but you do that over, say, 5 years, that will put you in the top group of S&P 500 companies, and therefore ahead of the average. And fortunately, we've been able to do that we give our investors three-year investment horizons, and try to do that in the last 4 three-year horizons in a row. We've been able to deliver that.
I should have asked you this earlier, Tim, but where does the name Broadridge come from?
Broadridge was the result of a extensive search at the time when we became a public company around what is still available.
Right.
So I don't think there's any...
Not Mr. Broad and Mr. Ridge.
No Mr. Broad, Mr. Ridge.
Right.
I think it is meant to convey strength and convey the breadth of what we do, but it's a sort of a made-up word.
Got it. You told me that you didn't want to go to work on Wall Street. after you graduated, first in your class in Princeton. I should mention that. Sorry to brag on you. Tell us about your journey. Where did you want to go to work, and how did you get here?
Yeah, that's funny. In university, I majored in engineering, computer science, and public affairs. And I thought I was going to go into politics. It's really I was going to apply to law school. And I ended up starting in investment banking. And then I had an opportunity to go into consulting. And I thought, well, if I go to investment banking, I'll end up living in New York, and I don't want to live in New York. So if I do consulting, I can go anywhere. And I ended up going to McKinsey. Was there for 15 years and did 10 of those in Minneapolis, which is a very nice town. Because I really, I thought I want to have a business of my own someday, and that would be a good route. And if I finally a client asked me to come and work for them, and if I knew how much fun that was, I would have done that many years earlier before I did. Then along the way, I had the opportunity to come and work with Rich Daley, who I mentioned to you, and I thought of someone who created a company and built it to what Broadridge was at the time. That'd be such an opportunity to learn and to build my skills, and that has certainly proved to be the case. Over the past 14 years that I've been here, as we've really, I think, transformed the company and took it on that journey that I talked about earlier.
I think you grew up in the Midwest somewhere, right? Or the
did.
Plains?
I did. I grew up in Fargo, North Dakota.
Right. What was that like, and how did that inform you in terms of your thinking these days?
I think when you think about the Plains states, it is getting up early, working hard. Everyone has to help each other. It can be 40 below in the winter, and so it does create a sort of an ethos of that. Sort of taciturn, but just get it done kind of ethos. I think the other thing in those parts of the country, there is only one school. Everyone goes to the same school, and so you really grow up with not some of the separation that you see in some other parts of the country, and that ability to connect with and communicate with and understand and value everyone, irrespective of where they're coming from, I think is a real core part of one of the values that I have, and certainly relates when I think about what we do in terms of giving investors a voice to influence corporate policy.
I think many people's notion of Fargo comes from that movie, or now the TV show,
Yeah.
right? Did that resonate with you at all?
Well, it's funny because when I first saw that movie, first of all, I walked out thinking, well, Frances McDormand is certainly going to win the Oscar, and she did. And also knowing enough of the nuances, if you live actually in that part of the country, say, well, really, that's not a North Dakota accent, that's a Minnesota accent, but we'll leave it there. And but it's a great movie.
And Tim, Broadridge sponsors the U.S. women's rowing team, right?
Yeah.
Do you want to talk about that? And that's an interesting facet, isn't it?
Yeah, it's something we're really proud of. When you look at elite athletes, particularly Olympic athletes, the training is very very tough, and for many of them, they have to do it many years. Really can set them back in their careers. And so when U.S. Rowing approached us about the idea of what we yes, we want you to sponsor us, but what we really want is internships for our athletes to be able to continue their careers while they're training. And we're fortunate that U.S. Rowing Training Center is in Princeton, New Jersey, which is we don't have a location there, but it's not too far away from New York. And what I think a lot of people hadn't cottoned onto yet is with the advent of remote work, it is much, much easier for people to work. These athletes work 20 hours a week. They come from great schools. They're very academic. They've done fantastic in their academic work. They have super discipline. They're super hardworking. And from our standpoint, the opportunity not just to associate with U.S. Rowing, but to hopefully have some people that will stay with us after their rowing career who will be really great Broadridge employees. And by the way, have been fantastic. They've been really adding to the teams that they're on. And I'm super proud to say that we will have 8 Broadridge associates that will be representing the U.S. in the Paris Olympics in August.
Wow, amazing. That's a great example of thinking different.
It's really, we're super excited about it.
Tim Gokey, CEO of Broadridge, thank you so much for joining us.
Thank you.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.